Good afternoon, everyone. We appreciate you joining us. As always, we have a full presentation today, so let's get started. Let's meet the team. We have Milt Fullen, Kevin Fix, Paula Miller, Justin Seidenwand, Brianna Stein, and Kelsey Fogel. I would also like to note that Kevin and Milt have again received the 5-Star Wealth Management Award for 2022. You make this award possible with your support, and for that, we're very grateful. As always, here are some disclaimers. This presentation contains the most current information that we have available. However, we are in a very fast-moving environment. We verify all of our information and obtain it only from what we believe to be reliable sources, but much of that information is subject to revision. This presentation is not intended to be used for personal tax or investment advice. However, our clients know that we provide such advice routinely, but when we do, it is in the context of your financial plans, and we have your financial details in front of us. Here's an outline for today's presentation. We'd like to provide you with some information on the TD Ameritrade Schwab integration. We will also discuss some information regarding Dropbox and our quarterly reporting. We will have a recap of the markets in 2022 and review some of the key market indicators. Lastly, we will conclude with some Q&A. We have allotted some time at the end of the presentation for this. However, feel free to ask your questions using the chat feature at any time. We also had some participants send us some questions prior to this call, so we'll probably start by answering those first. With that, I will pass it over to Justin to get started.
Thank you, Brianna. As you all know, TD Ameritrade announced in November 2019 that they had agreed to be acquired by Schwab. Our understanding, based on communications from our TD service team, is that Labor Day 2023 is the targeted date of conversion. We should be able to automatically repaper all accounts, so you as the client shouldn't have to complete paperwork as part of the conversion to Schwab. Our understanding is that your current beneficiary designations, move money capabilities, and other account preferences should automatically carry over to Schwab. We will keep you posted as more information becomes available. In the meantime, you can still access your TD Ameritrade accounts online via the website advisorclient.com. As we move into tax season, you may be wanting information from your TD Ameritrade accounts, such as tax statements, 1099s, etc. You can access all this information on Advisor Client, which can be accessed both on a desktop computer or on a mobile browser. There's also an Advisor Client app that you can download on your Apple or Android device. For those of you that use Advisor Client frequently, one question you may have is if you will still be able to access your accounts online once the conversion from TD Ameritrade to Schwab takes place. Fortunately, you will be able to. Schwab has their own version of a client portal called Schwab Alliance, which functions much like Advisor Client does for TD Ameritrade. Clients will be able to log in and access their accounts online, where you can view account activity, download statements and tax documents, initiate deposits to your accounts, and more. We also have the ability to link these Schwab accounts to MoneyGuide Pro, so the balances will update automatically in your financial plan post-conversion, just as your TD Ameritrade accounts update automatically now. In addition to having access to your accounts on the Schwab Alliance website, there's also a Schwab mobile app that operates very similar to the website. The Schwab mobile app is available on both the Apple Store and the Google Play Store for Android users. As you may be able to glean from these slides, both TD Ameritrade and Schwab's apps and websites have similar functionality to each other, and our expectation is that clients will have the same access to your accounts on the Schwab platform that you currently have with TD Ameritrade. As we move closer to the conversion on Labor Day weekend, we will provide you with more information about the conversion and getting set up on Schwab Alliance. At this time, there is nothing you need to do. Again, if you have any questions or need help logging into your Advisor Client in the meantime, feel free to reach out to your associate advisor, myself or Brianna, and we're happy to assist with any questions you may have. Now, before I hand it over to Kelsey, I believe we have a poll question. So the poll question is, what is the expected conversion date from TD Ameritrade to Schwab? So we have Memorial Day, July 4th, Labor Day, and Thanksgiving. So we'll give everyone a moment here to answer if you'd like. Okay, and clearly most of you are paying close attention because yes, it's Labor Day weekend is the targeted data conversion early in September. And with that, I'll go ahead and turn it over to Kelsey.
Thank you, Justin. I just want to spend a few minutes discussing 3 reports that are being uploaded into your shared Dropboxes each quarter and where they are located. Before we get into that, I'd like to first mention a few things about Dropbox and say that if anybody needs assistance with Dropbox or uploading any forms or documents, to contact me directly. My email is on the screen and I would be happy to help. I will also mention if there's anything that you would like us to look over or discuss with your advisor, to upload them into your transfers folder on Dropbox. The first report that's being uploaded is your Money Guide Pro net worth and asset allocation reports. These are going to be located in your financial planning reports folder on Dropbox. This report gives you your net worth summary with a detailed report of accounts and what information is being used to calculate your net worth. This report also includes a resource summary, your tax investments by tax category, as well as a worksheet detailing your asset allocation comparison. The second report is your Panoramics Performance Report. These are going to be located in your Performance Reports folder on Dropbox. This report gives you a detailed graph showing your portfolio value and performance history, which helps provide the big picture of your portfolio. The remainder of this report shows your account performance history, detailing portfolio returns and individual account returns. The third is going to be your fee statements. Now, these are not necessarily a quarterly report, but they are being uploaded onto your Dropboxes each quarter, and they are located in your fee statements folder on Dropbox. These statements show your account value, fee, and fee being billed to each account. If anybody has any questions regarding these reports, you are more than welcome to email me and I'd be happy to assist you. And now I will pass it over to Milt.
Milt, you're on mute.
Thank you. Let me start again. Thank you, Kelsey. Let me start by acknowledging that our tremendous client support team. Since we last met, Justin has completed the requirements to become a CFP. Brianna has become a senior associate advisor, and Kelsey has started her coursework to become a CFP. These efforts demonstrate their support to the industry and their commitment to provide the best, most knowledgeable service to you, our clients. Before I go further, I'd like to ask another poll question. The question is, what was the rate of return for the S&P 500 index in 2022? 33.15%, 26, oh, that's a negative 33.15%, a negative 26.83%, a negative 19.44%, or a negative 10.62%. Obviously, it was a negative year. So we'll give it a couple of minutes, not minutes, but a few seconds here. And see how people replied. Very good. I'll assume that you've read some of our previous reports, like Kevin's quarterly update. At this point, we know that 2022 was a poor investment year and that the S&P 500 was down almost 17.5%. To further highlight the 2022 investment results, I want to start by looking at one metric, comparing the earnings growth of the S&P 500 for 2021 and 2022. You can see that 2021 earnings growth was almost 50%, which was phenomenal. No one expected 2022 to be a repeat of 2021, and it certainly was not. However, 2020 earnings growth is still positive and projected to be around 5.2%. This is also below the 10.5% 10-year earnings growth trend. When we further break down 2022 earnings growth by quarter, we can see the trend through the year was clearly down, with Q4 projected to be a negative 2.9%. This is a graphic of the S&P 500 performance since 2007. You can see the 38.5% drop in 2008 and the 19.44% drop in 2022. However, during the 13 years between, the market rose steadily, achieving a healthy 12.03% annual return. So prior to 2022, no one listening to this presentation has seen a sustained market correction for over 13 years. Depending on how you measure it, that's 3 to 5 years longer than average. That means if you are under 40 years old, you have probably never had a meaningful amount of your money involved in a market pullback that has lasted this long. Conversely, if you're near or early in retirement, this may be the first time that you cannot simply work through the downturn and have your investments be unaffected by it. Even if you have meaningfully experienced this before, 13 years is a long time to remember how that felt and how it turned out. I'll apologize, but in the interest of creating a better handling of these situations, because this will not be the last time most of us see this, for the next couple of minutes, I'm going to remind you about what it was like, perhaps from a different perspective than what you felt previously. In particular, pay attention to how the news media is responding to this. How many experts are creating teeth-gnashing scenarios, fingers pointing everywhere? How much advice are you now getting as to where to put your money to keep it safe? Usually, this promoted safely comes in one of two forms. First, using products that provide downside protection while the downturn lasts, but then provides very poor returns after the downturn passes. These are often associated with penalties, heavy penalties, if you want to later switch out of these products. Or the second strategy, using new investment securities and strategies that have never seen the test of time. Have you heard the financial media explain that by remaining invested in a broadly diversified portfolio of indexes of the type that you are invested in with Fullen Financial, that these portfolios have come back from every downturn 100% of the time? Not likely. There is not a single alternative strategy that can boast a record of success like that. Not one. In fact, the most recent notable investment strategies had no track record whatsoever through a sustained downturn or otherwise, like the recent meme stock foolishness or the baseless claims that crypto would protect you in a market downswing. These strategies were being shamelessly promoted on the back of little to no supporting data whatsoever. I want to highlight this now while we're still going through this downturn, because these types of claims that this time is different have been going on for centuries. It begs the question, is the financial news media actually delivering useful financial advice, or are they using the current anxiety to promote some other agenda or to sell their products? History tells us that at some point we will come out of this market downturn and rise even higher. Maybe we have already started. Regardless, it would be very wise to remember and evaluate the quality of advice that most financial experts are now peddling when things are not going well, and then to reflect on it after this is over. And history tells us it will be over. I have gone through these downturns several times in my career, and the results don't reflect well on most financial media's expert advice. I have some files. I have some files of interesting predictions that I've accumulated over the years during market downturns. Most were totally wrong, and some now look downright ridiculous. However, given people's anxiety at the time, many of these were incorrectly given a sense of credibility. Before I go to the details of the investment results for 2022, I want to next look briefly at the probable causes of the current poor result. Understanding the reasons for the poor 2022 results is important. If 2023 is to be any better than 2022, we must have a good answer to the question, what specifically is going to be different? In other words, if we don't fix the problem, it's not going away. Inflation is the cause of the 2022 stock market retreat. There's nothing else. Before you think I'm crazy, let me point out that everything else that has occurred has either contributed to inflation or is the result of an action we are taking to try to bring inflation down. Let me start with the end of easy money policies, the end of stimulus checks, the end of near zero interest rates, and the reversal of quantitative easing. While one cannot help but believe that this is a contribution to inflation, its impact probably built over years and is difficult to measure. However, it is probably not a major contributor to the current inflation problem. The reason is when you look at global economies, you can see that inflation is higher everywhere, almost everywhere. Many of these countries had little or no stimulus, and yet they still have high inflation. Next culprit, supply chain disruptions. This problem permeates every global economy and is probably one of the more pronounced inflation contributors. This was initially caused by the sudden and dramatic shift in the economy to goods and away from services when no one could or would go anywhere. This caused enormous supply disruptions. Since COVID has become more manageable, we have suddenly shifted to services and away from goods. We are now seeing goods manufacturers and distributors laying people off, while most services still can't find enough employees. This swinging back and forth between goods and services has not allowed the economy to go back into an equilibrium. We have seen many service businesses close because they can't find staff. We've also seen many service businesses seriously understaffed, like airlines, restaurants, and healthcare. These service worker shortages and the resulting wage pressure are now the biggest contributor to inflation, and I suspect will prove to be the most difficult to bring back down. Next is China's application of their zero COVID policy and their subsequent sudden abandonment of that policy. China's zero COVID policy was inflationary for everyone except China. Zero COVID kept Chinese growth well below their trend and resulted in China being one of the only places in the world where inflation has not yet spiked. Zero COVID also kept global supply chains disrupted. Because of that, many companies are trying to reshore or nearshore their supply chains. But is that going to bring down inflation? This is turning out to be very costly, and if it is to be successful, it will take many more years to complete. Reshoring requires the building of all new facilities and factories, as well as finding and training scarce workers. While China's recent abandonment of its COVID policy looks like it is causing many unneeded deaths among its most vulnerable population, after the initial shock is over, it will likely lead to economic growth and ignite their inflation, much like it did in the rest of the world when they exited COVID. So while China's exiting of COVID will bring their supply chains at least mostly back online, it may also deal with the same swinging pendulum between services and goods that the rest of the world has had to deal with. This will likely keep the equilibrium between goods and services off kilter for many months yet, which may mean that while the probable growth is welcome, inflation will likely remain hard to get back to targeted levels. When Russia invaded Ukraine, it created an immediate disruption to oil and gas supplies, as well as some important foodstuffs. The cost of these goods immediately spiked. We have a long history of energy supply shocks and the negative impact it has on inflation. At the same time, energy prices have fallen from the early peaks and stabilized in large measure because of a milder winter in Europe and China's mishandling of COVID, which kept their growth well below trend and in turn substantively lowered their demand for energy. However, grain prices have not fared as well, which continue to inflate food prices. How quickly the world is able to move to replace Russian oil and Ukraine foodstuffs remain to be seen, meaning energy prices could spike again and food prices will likely remain high. Next, the US has around 3 million fewer employed workers than it had prior to the pandemic. The primary reason for this is the loss of workers due to early retirement. Unfortunately, our earlier predictions that these early retirees were not going to be enticed back into the workplace has turned out to be true. Another source of missing workers is because of low immigration relative to the levels pre-COVID. Another point that has not made the headlines is that a typical historical solution to some of the wage pressure has been automation. However, while it is somewhat easy to automate many manufacturing processes, it appears to be much more difficult to automate the services of a barber, an airline attendant, or a nurse. As a result, we are not seeing the major improvements in productivity that we have historically seen when we have experienced wage inflation. If you recall from a few slides back, I mentioned that if 2023 was to be different than 2022, we must see aspects of the economy that are different in 2023. Now I want to touch on a couple of items that are clearly different. The Federal Reserve has raised interest rates by 4.25% in 2022. Will even these historic rate increases be enough to reach their 2% inflation target? Will the annual additional rate increases expected in 2023, will it cause a US recession? That is a subject of great debate, and so we'll have to wait and see. However, there is no doubt that those increases are slowing demand and will, unfortunately, put people out of work. Even more uncomfortably, unfortunately, to reach the 2% inflation target means the economy will need to continue to slow. There's also no question that company stock values are down. Here I show the pre-COVID price earnings ratio and compare it to the current price earnings ratio. Note that I'm using a 12-month trailing earnings for this measurement. The PE ratio going down about 5 points from 24.88 to 19.89 is significant and shows the impact that the increasing interest rates have already had on company valuations. Now let's look at 2021 and 2022 investment indexes for the major asset sectors. Indexes within the box represent the basic asset classes of a diversified portfolio. The left-hand column identifies all the asset sectors that we generally follow. The three columns of numbers show the results by full year 2021, 2022, and the fourth quarter of 2022. In reviewing this, let me point out a few figures. I've already identified the major factors impacting these results, and that 2022 fell short of 2021 results. By comparing 2022 and 2021, you can now see how much the shortfall was by asset sector. Almost no asset sector was spared. But let me highlight two. Among the sea of poor performance, look at the AMX oil index, up by almost 52%. This is on top of a very high 2021 increase. For 2022, these high increases were in large measure sustained because of the Russian invasion of Ukraine and the shift from goods to services, which resulted in much more travel. The other asset sector I want to highlight is the US fixed income, which was down in 2022 by almost 15%. We have not seen a down year in fixed income like this for decades because we've not seen interest rate increases like this for 40 years. This also exemplifies that for 2022, there was no place to hide. Fixed income usually provides a safe haven for investors, but that was not the case in 2022. In fact, fixed income exacerbated the equity losses. This obviously happened. You're looking right at it. But this is a very unusual event. However, for 2023, fixed income may very well provide that safe haven again. For the first time in about 20 years, we're starting to see fixed income dividend rates of 3 and 4%. If rates continue to increase at a moderate pace, we will likely see higher fixed dividend incomes going into 2023. Not surprising, we have seen our fixed income yields go up substantially over the last 30 days. We had a client question about how to leverage rising interest rates, and we'll provide more detail about this when we address this in our Q&A. Now let me shift your focus to Q4 2022. How many realize that investment results for Q4 experienced a minor recovery? So far in 2023, the S&P 500 is up about 7%. That was a January record. Now let me direct you to the International Developed Country Index and compare that to the US equivalent large cap stocks. International clearly outperformed during Q4. In fact, except for energy, international developed markets increased more than any other asset sector. Interestingly, many of these countries, particularly Europe, are more exposed to the energy shock than the US, which means the continued energy volatility will likely disrupt this trend at some points. The second sector that I want to direct you to is the International Corporate Bond Index, which increased far more than the US Aggregate Bond Index. Well, this is not a fair apples to apples comparison. It does indicate another very real outperformance by international fixed income. I don't know if the international fixed leadership in equities and fixed income is going to continue for the remainder of 2023. I also can't tell you that the market recovery we have seen in Q4 2022 and into 2023 is going to continue. But let's be clear, in spite of some of the hyper opinions about it, no one else knows that either. However, let me tell you a few things I do know. International has lagged US equities and fixed income returns pretty much since 2009. More experts are expecting international investment returns to be higher than US returns for the next decade or so. I also know that there's more volatility ahead. Market ups and downs are never in a straight line. They're always a process over time. What else I have seen in the many market recoveries over the course of my career is that there are patterns to these recoveries that actually look somewhat similar. When a market recovery starts, no one is really noticing it. Most experts dismiss this as simply more volatility. When it does begin to be noticed, it is thought by most experts to be a head fake, a false increase expected to soon drop, oftentimes predicted to be to new lows. In other words, in every recovery I have ever seen, there continues to be a great deal more economic bad news than there is good news. And this bad news will go on for months into the market recovery because the truth is the economy remains in poor shape, even as the parts necessary for a market correction are starting to materialize. Remember, markets are not concerned with what is happening now. They're always looking to what comes next. Early in any economic recovery, very few experts are predicting the worst may be over, because the worst in the economy is not over. Notice I'm making a distinction between the economy and the markets. They are not the same thing. So any investor waiting for the skies to clear and a consensus of experts to unify around a message that now is time to re-enter the market, that has never happened, and it never will. Whenever I have seen anything approaching a positive consensus outlook among the experts, it is likely closer to the time to exit than to enter a market. In any investment market, this point cannot be overstated. Any investor trying to time markets is going to have to exit the markets when most aspects of the economy look strong. Then they are going to have to re-enter the markets when the vast majority of experts are telling them there is much more economic bad news on the way. It is no wonder that even the experts so underperform the basic market indices, and you are seeing why right now. I also want to be very clear. I can't tell you if we've started a market recovery or not. No one will know that for several months, possibly even a couple of years. That's because this is how recoveries start, often looking no different than the false starts that have preceded it. I have not included in this presentation research done by Fullen Financial, which concludes that the market actually starts to increase when negative company earnings growth begins to appear. The explanation is quite simple, that the market has already built in those earnings losses and it is now looking ahead for a rebound in earnings. I'm happy to share their analysis with anyone who would like to read it. My last slide before turning this over to Kevin takes a look at what a hypothetical portfolio for 2022 produced in yields. For this hypothetical yield calculation, I'm using the 6 major indices that make up a diversified portfolio. I'm also assuming that 35% is invested in fixed income and 65% is invested in equities, and that these investments were held for the full year. For 2022, this produces a negative return of 17.2%. This is consistent with our clients' 2022 returns, although it varies depending upon what the your actual asset allocation was. Now I will turn it over to Kevin to take a look at 2023.
Thank you, Milt, and good afternoon, everyone. We appreciate you spending some time with us today. I'm sure most of you are happy to put 2022 in the rearview mirror, at least from a financial standpoint, and we're all certainly hoping for better outcomes in 2023. So building on the recap that Milt just provided, I want to spend the next 15 minutes or so reviewing some of the key economic metrics and looking ahead to 2023, and then we'll have some time for your questions. Before we get into the outlook, I want to spend just a minute summarizing some significant new legislation that passed right at the end of 2022 called Secure Act 2.0. Some of you might recall the original Secure Act, which was passed at the end of 2019 and resulted in the beginning date for IRA required minimum distributions increasing from age 70.5 to age 72. It also changed some of the rules around inherited IRAs that were significant for non-spouse beneficiaries, which primarily affects those who inherit IRAs from their parents. Secure Act 2.0 further extends the beginning date for RMDs to 73 as of January 1st this year and to 75 starting in 2033. It also clarifies the distribution rules for inherited IRAs and increases contribution limits for employer retirement plans. Among the more interesting provisions is one that allows up to $35,000 of unused funds in a 529 college savings plan to be rolled into a Roth IRA in the name of the 529 plan beneficiary. Now, the details of this new law are too complex for this presentation, but they do highlight the importance of good tax planning when managing an investment portfolio. We think this is an area of strength for us, and we will talk a little bit more about these topics with you individually at our plan review meetings. Now let's move on to the economic outlook. And just to keep you all on your toes, we have one more quick poll question for you to answer. And the question is, what is the new required beginning date for IRA distributions? Is it 72, 73, 75, or never? We'll give you a little time to answer that one. All right, here are the results. 61% said 73. That is the right answer. So paying attention as we go through, that's good to see. Thank you, Brianna. So as I've done in the past, I want to start off with some context as we enter 2023. You might recall at this time last year, we were coming out of the Omicron surge, and there was quite a bit of optimism that things would get back to normal in 2022. Instead, 2022 was in some ways even more tumultuous for investors than the 2 years that preceded it. So consider the points on this slide. We saw the first cross-border war in Europe since the end of World War II. Inflation climbed to levels we have not seen since the early 1980s. Interest rates not only increased, but rose more quickly than they have in over 30 years. We have a labor shortage resulting in a record level of unfilled jobs in this country. The hot housing market and rapidly increasing mortgage rates led to housing affordability hitting its lowest level since the early 1980s. And 2022 was the first year that we saw simultaneous corrections in both the stock and bond markets in more than 50 years, with a correction being defined as a decline of 10% or more. Clearly, there were plenty of reasons for the markets to struggle in 2022 and for investors to be uneasy here in February 2023. Now let's take a look at some key metrics and what they might be signaling to us about the year ahead. The first metric we have is GDP growth, and on this slide, we're showing the year-over-year growth for the past 3 years. Looking at these results, you can see the whipsaw effect the pandemic had on GDP, with a pretty significant economic contraction in 2020, followed by very strong growth in 2021 as the economy reopened. Over the course of 2022, GDP was slightly negative in the first 2 quarters of the year, followed by 3.2% growth in the third quarter and 2.9% growth in Q4. Growth in the fourth quarter actually exceeded expectations of many analysts and indicated continued economic strength despite the tightening monetary policy at the U.S. Federal Reserve. For 2023, GDP growth is expected to slow, both in the U.S. and globally. GDP declines are expected in the Euro area and Russia, offset by relatively strong growth in Asia. Growth is projected to be a modest 1% in the US and about 2.3% globally this year. One big caveat to GDP is the China situation, where the government is moving away from its zero COVID policy. It's unclear what the initial impact of this reopening will be on consumer demand and the supply chain, but expectations are that both demand for goods and services, as well as the supply of goods to overseas markets, will increase as we move forward. Now let's look at inflation, which Milt covered at some length a few minutes ago. It certainly appears inflation is headed in the right direction, but there are several factors that could keep prices elevated as we go through 2023. First of all, labor costs in the US remain stubbornly high, and I'll go into a little more detail about that in a couple minutes. Secondly, inflation in the UK and the Eurozone is still higher than in the US, primarily due to higher energy costs resulting from the war in Ukraine. The European winter has been relatively mild so far, but any significant increase in their energy demands is likely to reverberate through the global energy markets. And the third thing is the China factor, which I just mentioned. And as Milt said earlier, because inflation has been the catalyst for the market pullback in 2022, it makes sense that it will be watched very closely as we move through 2023. Now, I want to take a little bit more close look at the labor market, specifically unemployment and labor market participation. As you can see here, unemployment at the end of last year was still at the so-called full employment level we saw in 2019, despite actions by the Fed to slow the economy. And in fact, we just saw a very strong jobs report late last week, which took the unemployment rate down a bit further to 3.4%. Yet even with this low unemployment rate, unfilled jobs rose to historically high levels in the first quarter of 2022 and remained above 10 million at the end of the year. Wage inflation is not surprising then, as employers compete for workers in a labor market that's already near full employment. Solving this problem will require either an expansion of the labor force or a significant increase in participation by the existing workforce. While the labor participation rate did increase modestly in 2022, it was not enough to have a meaningful impact on the current labor shortage. The bigger issue seems to be population growth, which has been on a downward trend in the US for several years, as we can see on the next slide. In fact, in 2021, US population growth of 0.1% was the lowest it has ever been in our history. There are several factors behind this, but one of the largest contributors over the past several years has been reduced immigration. The bottom line is, as population growth slows and labor participation rates remain in a narrow range, immigration will have to increase significantly, even above pre-pandemic levels, to take up the slack. Unfortunately, current US immigration policy is hampering this effort, and meaningful change on this front is not likely anytime soon. So in our view, labor costs are likely to be a key driver of inflation in the short term and a damper on economic growth in the long term. Now, Milt talked about the impact inflation has had on interest rates, and you can see that clearly on this next slide. Since the end of 2021, the Fed has increased interest rates 7 times by a total of 4.25%. And it's not just the amount of the increase, but the pace of those increases that contributed to the market pullback in 2022. In fact, when I prepared this slide last year, economists were estimating the Fed funds rate would be at 1.25% to 1.5% by the end of 2022. High inflation in the spring and summer changed all of that pretty dramatically. So how much higher will interest rates go? The Fed continues to signal a target inflation rate of 2%, but the economy is still growing and labor remains in short supply. Therefore, it's likely the Fed would have to raise rates much higher than they are now to achieve that inflation target, with a potentially devastating impact on the economy. And if you look at the futures market for interest rates right now, it's signaling the Fed will actually start to cut interest rates later this year in response to a weakening economy. This all starts to bring back unpleasant memories of the 1970s and early 1980s, when the Fed went through a series of interest rate increases and cuts that ultimately produced inflation rates of almost 14%, and the need to raise interest rates to more than 19% to bring inflation under control. This is not territory the Fed wants to return to, and Fed Chairman Jerome Powell has said as much, but market participants seem to be questioning if the Fed will have the political will to keep raising interest rates. This will be a key driver of market performance and market volatility in 2023. I also want to make just a couple of points about longer-term interest rates as well, which have continued to rebound from their levels at the end of 2020. Although rates on the longer end of the curve have increased, they are currently below the short-term Fed funds rate, meaning the yield curve is now inverted. Historically, this has been associated with economic recession. Just as importantly, though, lower long-term rates also signal that inflation will likely moderate over time. So in that sense, this is a positive signal. The rate for a 30-year fixed-rate mortgage has also risen substantially over the past 2 years. And in fact, the 30-year rate ticked above 7% for a couple of months in the fall of 2022. This has had quite a cooling effect on the housing market, particularly in new home construction. The housing sector is a big driver of consumer spending activity and employs a lot of people. So higher mortgage rates, like higher Fed funds rates, will have a negative impact on economic growth going forward. Higher interest rates will also have an impact on the national debt and budget deficits because a large portion of government debt is short-term in nature. As that short-term debt comes due, it will have to be refinanced at significantly higher interest rates, which will take government spending and deficits even higher. As you can see on this chart, national debt as of September 2022 was a record $30.9 trillion, an increase of more than $1 trillion from the prior year. Debt levels are up by $4 trillion in the past 2 years and almost $8 trillion in the past 3 years. Unfortunately, in a rising interest rate environment, this amount of borrowing becomes much more burdensome, and interest payments on the national debt will start to crowd out other spending programs or will simply add to the deficit. And as we all know, the only other lever the government can pull to reduce budget deficits is to increase taxes. Since the 1960s, however, the focus has been on cutting taxes, reducing the highest marginal tax rate from 90% down to 39.8% over that time period, resulting in rates today that are actually quite low, historically speaking. We do believe this debt picture puts upward pressure on tax rates for both ordinary income and capital gains. And this would have negative implications both for economic growth and for the longevity of our investment portfolios. In an environment of rising taxes, tax-efficient investing and withdrawal strategies become more important than ever. Staying on top of changes in tax law and incorporating those changes into effective tax planning strategies will be extremely important for the long-term investor. So how are all these issues reflected in consumer confidence? As you can see from this chart, consumer confidence is down somewhat in 2022, but still well above where it was in 2020. You may recall this index is based on a survey of consumers that asks them to express confidence in the current situation, as well as expectations for the future. Interestingly, the biggest positive driver right now is consumers' view of their current situation, while their expectations for the future have diminished significantly. In fact, the December reading for current situation was 147.2, while the future expectations index was just 82.4. And notably, a future expectations index of 80 or below has also been an indicator of economic recession. That reading was at 76.7 in November. Keep in mind, consumer confidence is a tricky measure. It's driven largely by non-quantitative factors like emotions and psychology, and consumer spending represents about 70% of GDP. It's also an important measure, though, because I think it provides a good link between where things currently stand with the economy and the markets and where they're likely to go as we move forward. Despite all that happened in 2022, the U.S. consumer showed a great deal of resiliency and helped keep the economy growing. However, as they see the impacts of inflation and higher interest rates on their wallets every day, the future outlook has taken a hit, and we're seeing the impacts of that in the financial markets as expectations for future growth come down. So what are the questions to be answered in 2023? Milt made the case that inflation was the key issue in 2022, and it will continue to be the center of attention this year as well, at least in the near term. Inflation will determine how much higher short-term interest rates will go and how long they'll stay at those levels, which in turn will impact company earnings, the housing sector, and perhaps most importantly, consumer sentiment on the economy and the markets. And what factors are likely to drive the outcome on inflation? Labor costs will stay squarely in the picture as we try to reach equilibrium between the goods economy and the service economy. Russia remains a big wild card for Europe, and it's likely that Putin will continue to be a destabilizing force in the global economy. And China's reopening with the sheer size of their economy is sure to drive additional demand for energy, commodities, and other manufactured goods. So the recurring theme really is that we expect continued market volatility in 2023, at least until the inflation picture becomes more stable. So here are some conclusions from today's presentation. There will be temptations to react to short-term market movements, and it's very important to stay disciplined. Additionally, in times of market volatility and uncertainty, the case for a properly diversified portfolio using broadly diversified index funds is as strong as ever. Trying to pick winners or avoid losers in such a volatile and uncertain environment is impossible and has the potential to do lasting harm to your portfolio. We've developed an allocation strategy for each of you that fits your particular financial circumstances, your goals, and your time horizon. Your portfolios are designed to withstand short-term market downturns because we have a good idea of when you're going to need that money, and we've allocated your assets accordingly. We can't control what happens in the markets, but this investing approach, combined with tax planning strategies, as I mentioned earlier, keeps us focused on the factors we can control, like investing costs and taxes that can have a meaningful impact on long-term portfolio performance. So in this type of environment, keep a level head and stick with a financial plan. If any of you want to discuss these issues in the context of your own plan, please don't hesitate to contact us. That concludes the presentation, and at this time, I'll turn it back over to Brianna to take us through the Q&A.
Thank you, Kevin. We will now open the floor to questions. You may ask your questions using the chat feature in the lower center of your screen. We did also have some questions sent to us prior to this call, so we can begin by maybe answering some of those to give participants time to think of their great questions. So the first question that we received prior to this call, and maybe Milt, you can take this to give Kevin a breather. Do I have any alternatives to the 0.1% interest I am earning on my savings account?
I'm going to say yes, but before, and I'll get into an explanation, but before I do that, we did have one question come through earlier as well on the conversion from TD Ameritrade to Schwab. Will the account numbers change? And I believe, I'm almost positive the answer to that is yes.
Yes, they will.
Yeah, so the point is you will have to go through and contact any employers. If you've got automatic deposits and withdrawals, we may have to reestablish some of those. So there will be some work around that. Now, back to your question. Are there alternatives to sort of the low paying interest rates on savings accounts? And the answer is yes. And these are becoming more significant as interest rate increases have occurred in the economies. And we're seeing it as I mentioned earlier, in our own fixed income investments. We're starting to see yields like we haven't seen in several years. And there's basically two things that you can do. One thing you can do now, and another thing that actually Fullen Financial is in its final stages of review, and we're going to be offering something in a couple of weeks. Anyway, the first thing that's available now is while most major brick and mortar banks do not offer high yield savings and money market accounts, many online banks do. So you can Google for those or do online searches for those, and setting those links up between current checking accounts and these money market accounts, which are paying actually as high. I mean, I've seen them as high as 4%. However, when you set these up, I would make sure that you have FDIC insurance, which is up to $250,000 per Social Security or FEIN number per bank. Now, as I mentioned, within the next couple of weeks, Fullen Financial is going to start to roll out this service that links our clients to a network of banks that are currently offering, again, it's 4% money market rates on amounts over $100,000 and less than $1 million. over 1 million up to a maximum of 25 million, the rates drop around 0.5%. All funds in the program are FDIC insured, and these rates will change as interest rates change. The way we're achieving this is we're actually partnering with a technology company that has relationships with several hundred FDIC insured banks across the US. From our clients' depository account, their funds will be distributed to member banks up to the available FDIC limits. So each participant will have an FDIC insurance account at one bank, and when the FDIC limit is reached, the next amount of cash will be invested in an FDI insured money market account at another bank. This vehicle will be available to companies as well as individuals. While there is no minimum investment period that these funds need to be held, there is the minimum aggregate investment of $100,000. So we're going to be asking many of our clients to combine their emergency funds, their car savings funds, as well as any other idle cash they have, so that we can possibly get them into the system. We think it'll allow a pretty nice yield on otherwise idle cash. And our understanding is that if the amount dips below 100,000, the account will not be closed. So in any event, more will be coming on this in the near future.
Thanks. Another question that we received, Kevin, maybe you can take this one. Bond values have taken a big hit this year. Are bonds still a good investment?
Yes, we've always believed that bonds are an essential part of a properly diversified portfolio. We continue to believe that. And it is true that, as Milt said in his presentation, that bond values were down significantly in 2022. But it's important to remember what caused the drop in value. You know, unlike stock values, which can change for any number of reasons, government bond values are purely a function of market interest rates and the time remaining until the bond matures. Corporate bond values are also driven primarily by interest rates, but they also reflect a credit spread that factors in the risk of default. So the drop in bond values in 2022 was really caused by the rapid increase we saw in interest rates due to the Fed's monetary policy, because as those rates increased, bonds that were already in the market paying a lower interest rate had to decrease in price to reflect the current market yield. And, you know, seeing that kind of drop obviously is painful, but it also makes it easy to overlook the fact that bond portfolios are now delivering much higher rates of return because of those higher interest rates. So, for example, if a bond portfolio lost 15% of its value, but is now yielding 4% instead of 1%, that loss in value will be made up over time by the higher yield. And these higher interest rates, if they stay with us, will be quite beneficial for bondholders over the long term. And I guess the last thing I'd say is just to note that Fullen Financial generally has not included long-term bonds in our portfolio recommendations. The longer the term of the bond, the more sensitive their value is to changes in interest rates. And because we've been focusing more on the short-term and intermediate-term bonds with our clients, the impact of the recent rate increases has not been as significant. And those clients have been able to participate more in the benefit of those rising interest rates as shorter-term bonds mature and those proceeds are reinvested. So yes, despite what happened in 2022, we continue to believe in bonds, and it's not just for their lower risk profile historically, but the fact that now they're also starting to pay higher yields, which we really haven't seen in a number of years.
Thanks, Kevin. The next question is, should we be considering Roth conversions?
I will take that one. And let me start my answer by saying that a Roth conversion is about tax savings. And remember that the goal of tax savings is measured by how one makes their life, how low one can make their lifetime tax bill. For example, paying very low taxes in one year and having to pay more to offset that savings and even higher taxes in the future is not really saving taxes at all. So with legislation, a constant state of flux, monitoring tax rates and the application of has never been more important. Missing the impact of a legislative change, even for 1 year, can mean paying more taxes than you're required, in some cases by quite a lot. Also, given today's high deficits with Social Security and Medicare contributing more and more to those deficits as the retirement population grows, it's hard to imagine that tax increases are not in the future. And as Kevin mentioned, we're in more or less a pretty low historical tax rate, so it's probably going to be looked at as a potential solution to funding some of these programs. The bottom line is tax planning is becoming more and more critical part of one's financial planning. Now, the phases of tax planning cover one's entire financial life in various forms. There is a particular period that is most receptive to tax planning than other years, and that's the years between retirement and when one starts Social Security, required minimum distributions, or any other retirement accounts that they have. So there's often a gap, in a lower gap in earnings when someone enters that those early retirement years. Okay, that is one of the prime areas where one of two things can be done. I mean, most of our clients have very large unrealized capital gains, and during this early years of retirement, we can frequently cash out those unrealized capital gains at very low capital gain tax rates, in some cases even a zero capital gain tax rate. And now this brings me to the Roth conversions. The other area of tax savings is to complete a Roth conversion. Remember, however, that for a conversion to be tax effective over one's lifetime, it must be done at the same or a lower tax rate than is anticipated in the future. Remember that all funds converted to a Roth are permanently removed from all future income and tax liabilities, and not just for yourself, but for your heirs. Lower retirement income also provides the opportunity to use lower rates than would have been when one was working, and before they start their Social Security pensions and retired minimum distributions. In any event, these low periods can not only be found in early retirement, but also if someone loses their job unexpectedly or something like that. Anything that causes a sudden drop in income represents a potential tax opportunity.
The next question is, should we assume a higher rate of inflation in our financial plans?
Yeah, I can take that one. You know, we have been getting this question a fair amount. We have not made any changes in inflation assumptions in our clients' financial plans. For most expenses, we're still assuming an inflation rate of 2.25%. That inflation rate does increase for healthcare up to about 5% and for education costs to about 6%. Obviously, the inflation we've seen over the last year has been higher than anybody expected. But as we talked about in our presentation, we attribute a lot of that to supply chain problems, labor market dislocations, other issues resulting from the COVID pandemic. We don't expect these factors to remain with us for an extended period of time. And the economists that study these numbers pretty much agree with that. In addition, the Federal Reserve has stated repeatedly that a primary goal for their monetary policy is to maintain low and stable inflation at a rate of 2% per year. What we have talked about with clients as it relates to inflation are the starting points for their spending assumptions, which are stated in today's dollars, and whether these dollar amounts need to increase given the higher price levels we're seeing today. In some cases, we have made changes. In others, we found the client is able to adapt to the current environment without changing the base spending assumptions. And it's also important to remember that the current inflation that we're seeing has resulted in the Fed significantly raising interest rates, as we've been talking about, to cool down the economy. This increase in investment returns is likely to continue if inflation stays high. And we haven't changed any of our rate of return assumptions either. So for right now, we don't expect any assumption changes for inflation or for investment rates of return, but obviously we continue to monitor these very closely. And as we consider making updates, we'll have conversations about those with all of our clients.
Okay, we also have a question in the chat box now. Do either of you have any comments on what President Biden will discuss re the economy in tonight's State of the Union speech? Milt, you're muted.
Yeah, I'll take a first cut at it. I'm smiling, maybe even laughing. It's hard to predict what any politician is going to say, quite honestly. I'm sure there'll be a positive spin put on things. I mean, one thing I've seen and read that President Biden has said so far relative to the unexpectedly high jobs report that came out, certainly trying to emphasize the positive that his administration has created all these jobs, et cetera, et cetera. And I'm not trying to discredit him at all. But I don't know that politicians, at least in the short run, have too much influence on markets and what markets are going to do next. And I would say that relative to Republican and Democratic presidents. I mean, there's certainly policies that they can put in place that will have an impact, generally longer term. But as far as bringing down inflation, et cetera, that's more or less been turned over to the Federal Reserve. I think there's things that Congress can do, but they're not doing them. So it's pretty much all on the backs of the Federal Reserve to deal with the inflation problem. I don't know, Kevin, if there's anything you want to add about that.
No, not really. I think it is hard to predict what might come out in these speeches, and it'll be interesting to see what he has to say.
Okay, so we don't have any other questions in the chat. Maybe we can just give it a minute and see if anybody has any final questions. If not, I think we can wrap up.
Yeah, I just want to thank everybody for participating and spending, I know, your time listening to us. We hope that you've gotten value of it. And if you have any questions, comments going forward, don't hesitate to reach out on an individual basis, and we'll do everything we can to help you. Okay.
Okay.
Thanks, everyone.
Yes, thank you.
Your time.